Thanks everyone for joining us. Have a great panel for you today. So we'd like to kick it off with a question to Fabian. You know, as you at Moody's talk to the biggest financial institutions in the world, what's changed in the conversations that you're having in the last year?
I guess I have 3 hours for that one. No, I'm kidding. I'll take one. Let me take one step back maybe and give you some context so that I can tell you what has changed. And I'll illustrate my point with DLT bonds, so bonds issued on blockchain platforms. The first one was issued in 2017. So it's been roughly 8 years, but yet more than half of them have been issued over the past year and a half. So since the beginning of 2024. So the acceleration is clear. It's happening. It's still a tiny market, by the way, but it is happening and it's moving forward pretty fast. Now, what's striking, interestingly, is the regional differences. Out of the bonds I mentioned before, like 105, a little less than that, 104, since 2017, 2/3 of them have been issued out of Europe and 1/3 out of Asia Pacific, meaning apart from a handful of tiny like POC-like tests in the US and other regions, but the nominal amounts were so small that they don't really matter here for this story. Activity has been essentially outside of the US. And one of the key reasons for that is that in Europe and in Asia Pacific, they've had better regulatory clarity overall. And I mean, actually, I had the discussion with some of you over dinner last night. We've heard, and with you earlier today, Kelly, we've heard for years, oh, security is a security, we have securities laws, and all that stuff can happen with securities laws. And the answer is yes, you're right. You have securities laws, but they were written way before DLT was even thought about. And for many market participants, there's not enough guidance to know what it really means in practice to do DLT stuff and securities on the blockchain in particular. But when you look at countries like Germany and France and Luxembourg and Switzerland, well, you have that. It's available. You have literally guidance from regulatory bodies telling you what it means to do securities on chain, and that extra regulatory clarity has created that capacity and that activity that we've not seen here in the US. So now everything has been changing for the past few months, as you can tell from the headlines since the beginning of the year, and as you can tell from all the discussions today, and since earlier this summer on stablecoins, since the Genius Act passed. So there's going to be a lot happening in the US. So what's changed, really, to go back to your question, Charlie, is not that much. First, because global financial institutions have been getting ready for a while, and they didn't really care where they were getting ready. They were getting ready for a digital shift. And a lot of what they've been doing, like data preparedness and technology preparedness and risk management preparedness and all that stuff, they've done it live in Europe and in Asia, but they can also do it in the US when the time comes, and they're just getting ready to have more work done here going forward. And the other reason why I'm saying it's not changing that fast is there's a lot of things happening through regulatory activity, but there's going to be an implementation period that will take some time as well before things are stable enough for people to feel confident that they can get into the mix and really invest and interact with the digital finance ecosystem.
Makes sense. And similar question to you, Arnaud. On the Dune side, of course, a much more crypto-native data player in the space. What's changed in terms of like the more crypto audiences that you're talking about in regards to tokenization and the role that Dune can play in that?
Yeah, so first of all, like many of you may have heard of Dune. I think, Timm, you were joking last night that if the traditional finance run on Excel spreadsheet, the DeFi world runs on Dune's data. And probably we would not be part of this conversation about a year ago And I think we have had the largest growth in the, I would say, institutional world. And I think many companies that we are, I guess, interacting with start from, we look at things through the lens of data. So they usually engage from a tokenized treasury, right? At least many of them, that's how their first foray into the world. And then I think what's very exciting is that with the diversity of organization that we work with, we have people are different stage in how advanced they are, I would say, in their tokenization journey. And from, again, tokenized treasury on the starting point, but also more, I would say, interesting in like experimenting, right? Especially with the more friendly, I would say, regulatory environment, things like private credit pool, like Maple or things like this. So I think it's quite interesting that seeing all those organizations, I think, either putting their toes into the water or like looking at things that are providing a little bit more risk, a little bit more yield. Some of them have been doing for a little while, and some of them are just getting started. It's all good. I think this summit is a great reflection of people that are different journeys, in terms of crossing the chasm. So, yeah, I think we're excited to provide them the data, to support them and help them understand what's happening on chain ultimately.
And now going over to Timm. So you're building Particula, which is a ratings provider for on-chain tokenized assets. With everything on-chain being transparent and more of that data being out there in the open, is ratings going to be more or less important going forward than in traditional finance?
I guess generally speaking, Charlie, it's important to outline, first of all, what is really the role of a rating agency in the overall market landscape. And it's mainly about reducing information asymmetry and give the stakeholders that are active in the market the necessary trust and transparency to really funnel liquidity into those offerings. And I guess with tokenization, ratings will remain equally important, even getting more important, but the work behind those ratings will change. So on the one hand side, providing a rating for tokenized assets, especially when they are permissionless, is more complex. But on the other hand side, we also have the possibility to make ratings more transparent, more data-driven, and also executable on chain. And maybe to get back to the first point, why it's more complex, many people, especially when they are looking into the risk of tokenized assets, they misunderstood one of the major core premises, which is that tokenization is changing all major product features. So independently from the underlying asset, whether we are talking about a single asset, a basket asset, a former analog asset, but also digitally native assets, when you tokenize it or add additional smart contract, major product features change. So you have new valuation frameworks, you have new legal and compliance frameworks compared to former analog assets. You bring those assets differently into your balance sheet, into your tax declaration, and you have a complete new infrastructure where those assets are traded on with unique risks, but also unique capabilities. And what we are currently seeing is that the same underlying asset, like US Treasuries or now public equities, are tokenized by different providers out of different jurisdictions with different tax stack and ownership rights, and the implications are huge. Because recently, especially here in the US, after Robinhood launched their tokenized equities, there was a huge discussion, what is this token all about? Which kind of ownership rights are attached to this token, and what are the implications? So investors who currently want to build on-chain exposure to a certain underlying asset, they are currently looking at the market. They see 10 different issuers with additional 20 new counterparties like tokenization providers, specialized custody providers, Oracle providers. They are seeing that those issuers are launching on 20 different blockchain ecosystems with unique capabilities like governance, performance, security. And they are seeing that the end product has different ownership rights, different obligations. And therefore, I guess there's a huge need for rating providers to step in to create this transparency and reduce the information asymmetry, which is currently exaggerated in the market. And this is getting more and more important the fancier the products are getting. So currently we're seeing RWA vaults, we are seeing lending protocols, the possibility for retail investors to even loop them. So I like to compare this sometimes at least to 2008, where you have this kind of Yeah, it's a Matryoshka situation. So Matryoshka is a Russian puppet, and when you open it up, the same puppet is in there, just a little bit smaller. Yeah. And this is a good analogy to what we are currently seeing in the market. And therefore, it's important that rating agencies, traditional credit rating agencies, but also specialized providers like Particula, are stepping in to guide investors and not only focus on the credit risk that is associated with the underlying asset, but look on the unique change of those product features and adjust their methodologies and procedures to assess risk across all those product features. Yeah, so also technical implementation and security, specific legal and compliance implications, as well as all kind of market-related aspects.
Let me jump in here and add to what Tim was saying. Maybe just another step back. You have lots of providers of risk indicators out there for credit or other things. The question is, who is using that credit assessment, that score, that risk assessment, and what is it used for? So if you are a financial institution and you're trying to use your rating for your rating assessment for regulatory purposes, for capital relief or whatnot, you will need a rating from a nationally recognized statistical rating organization, so traditional rating agency, and you can escape that. You need that work, so you need ratings no matter what. Now, if you're a retail investor and you're trading in the DeFi space or investing your own money in some of those assets we've been talking about, actually not really real-world asset tokenization, but more like crypto, then you probably need other scores. And certainly, if you're not guided by the traditional financial institutions in your decisions, you probably need also to see that extra data that will be helping you make informed decisions with respect to your investment choices. So there's plenty of room for all those scores, but again, there's plenty of needs out there, and we're all offering different things. And in many cases, and happy to touch on that at some point, we've actually, with Timm and with you and with others in the room, we've been testing ways to get data, for instance, things that we would not be otherwise collecting directly from the issuers and the structures that we rate. And then there's providers out there that can do that. So it's a good complement to traditional ratings systems as well.
But don't you think that, so it's my understanding as we look through the lens of data that like a lot of that data on the, I guess the loan level is on chain, so it's available. So your risk assessment is almost as good as the data as an input, but there's still way too much information that's off-chain, right? So how can you build true risk assessment if you don't have the info from a default, a restructuring? I mean, it's still like we have almost like a two-word, but, and we're getting there, right? It sounds like you guys are the expert, but for me, maybe it's a little bit more of an, forward thinking, like how do we forget the PDF that takes a week to inform you. Do you think it's more because we don't have the technology to bring this component on chain today? Do you think it's more controlling the narrative? Some of those companies worrying the market. Like, why can we not have this second portion of the data on chain?
So it's a little bit of both. Some of it is technology maturity, even though some of the work that we've tested with many of you here and we've announced publicly over the past few months shows that we have a playbook to do that. And if we want to bring in native data to do our rating work, we can do it. And it's been very successful. I'm glad we can do it today. Now, and to your point, Timm, earlier, and what you just said, Arnaud, having that extra transparency and having that flow of data from independent sources that collect that stuff for you so that, similar to what we do with audited financials. Forget digital finance. When you rate stuff, you start with audited financials that you get from firms whose job it is to audit financials, and they have a fiduciary and legal responsibility to do it well and to provide numbers that are standardized, and which is how we start our credit risk analysis. So we need that data wherever it is. We need to onboard it, ingest it, and make sure that if there's predictive power in it, we can use it. So in fact, and that's something we discussed, Charlie, you asked me before, do we need to change rating methodologies to account for that? And I'll say probably not, but I'll explain that it's not a full answer. So probably not because the first thing that we do, a bond is a bond, whether it's a DLT bond or a traditional bond. First thing it is a bond. So you look at the credit rating methodology for the sector, the asset class, the type of issuer that you're looking at, and you look at the primary credit risk drivers that are described in that methodology, and you have most of the story there. Now, when you follow the cash flows and you try to see whether those cash flows will really go to investors as planned, or if they could be trapped anywhere, including in the structure itself, in the issuer, well, devil is in the detail, and sometimes you can see that some considerations related to the blockchain platform, the governance around the blockchain platform, smart contracts life cycle, legal representation, asset representation, regulatory risk, cyber risk, all that stuff could trap that money. And in that case, we need to consider those additional considerations that can add to the credit analysis some real meaningful predictive power, some real value to your rating work. And at that point, that data, you may sometimes be able to collect it yourself. So the rating agency could go and grab it. In other cases, you may get it from the issuers that you're working with. But down the road, it will likely be for firms like yours guys to provide that as the auditors, in my example of audited financials, that give us the data we need to start the work. So
are we years away, or are we months away?
I think, again, a little bit of it is technology readiness, and not everybody is ready to be on chain anyway. I mean, the panel, or 2 panels before launch, they were talking about it, and the fact that you still have like a real gap between supply and demand. So you have a lot of people getting ready here in the room and outside of this conference venue, getting ready with digital assets, how to issue them, how to do everything. Regulators are getting ready, structures, lawyers, a bunch of people. When it comes to the buy side, when it comes to investors, there's not many people in the room willing to have the discussion with the sell side. There's still a lot of,
I see people nodding.
Yeah, and it's true. I mean, there's still a gap between supply and demand, and people are telling you, well, is it like a solution to a problem I don't have? I'm still thinking about FTX and whatever, Terra Luna. So there's still that anxiety in the space. There's a need for education. There's a need for, back to the point, Tim, on traditional ratings and traditional methods. What we've seen over the past few years is we've been rating digital assets, bonds, funds, whatnot. We've been writing a lot of research. And suddenly we've reconnected with investors through that work because we've been telling them, well, forget the buzzwords of crypto, and here's what it means for you from an economic and financial perspective. Here is what tokenization can do for you, and stablecoins and CBDCs and whatnot. And when you have that discussion, suddenly you have that buy side that thinks, okay, well, I'm seeing it, but when I heard it only from like crypto native firms and from technologists, it was very scary. Yeah, so a bit of it, apart from pure technology preparedness, a bit of it is just that appetite and that lack of education or need for additional education so that the gap between buy side and sell side narrows down.
I guess one additional point, which is really important. So when you talked about what do we need to have in place and what we can do with the data, I guess it's accurate, and I would agree, but only for permission system and a little bit dependent on the purpose. So when we're talking about permission systems, where we have KYC, AML investors, where we have a institutional grade infrastructure, and the parties who are involved, the cash flows because they're integrated in a smart contract up front, and you want to do a initial assessment with a periodic review stating the credit risk, this is totally true. Yeah. What I see is that those aspects and also the challenges are changing when we are moving into permissionless systems and when we have a different purpose. Yeah? So the main difference from my perspective, when we're talking about 24/7 markets, we also need 24/7 risk assessment. Yeah? And we need to create systems that are able to aggregate data, harmonize and verify it between on and off-chain sources, and assess it in real time. Yeah? So this is a critical gap that we need to create additional revenue streams, but also new business models. So for instance, utilizing ratings or risk assessment as a baseline for automatic listing and delisting on exchanges or with custodians, to utilize them as on-chain policy guards for portfolio management, or even create tiered TVL or liquidation bonus approaches with lending and borrowing protocols. So then the requirements completely change because you're interacting with counterparties you are not familiar with, you have higher complexity, you need to assess additional risk factors because you cannot state that the infrastructure is coming without any kind of additional risk. And you need to differentiate between risk profiles of tokens that are launched on different blockchain ecosystems or are interacting with different service providers.
The complexity increased because of a different chains on top of that.
And because of the different purpose. So when we get into the situation that we have an issuer relationship, they are providing the data, we can assess it, we can look on the permission system. It's not different compared to a traditional credit rating procedure. You do not need a new methodology, you have the same client relationship. But when we really want to make the next step forward and create also solutions for DeFi natives to utilize ratings as a guideline, we need to have those data pipelines. And we need to rely on providers like you guys who are utilizing or creating index blockchain data so that we can run our analysis on chain and not build it in-house. And we need to create data pipelines to automatically harmonize data inputs from different sources. And one example is, for instance, and it's an easy task, but it's already complex. When you look at the product implementation, you also need to assess the smart contract. So which functionalities are incorporated in a smart contract and what does it mean for the investor? And now we see the need to harmonize the smart contract functionality with the terms and conditions. So is it aligned? What's promised? And then you also have regulatory frameworks. I guess Hong Kong has one of the most advanced regarding stablecoins when it comes to requirements of on-chain functionalities like freezing and pausing functionalities. And most of those smart contracts are upgradable. So an issuer can decide, okay, overnight I'm changing the terms and conditions and I'm changing the smart contract, and then you have a complete new product. And I guess this is really the thing that we're seeing from a general data aggregation perspective. We need more robust data pipelines. We need to create liability for the data because currently nobody's taking the liability. And the system is running on wrong data, and many of us know it, that it's wrong data. And on the other hand side, it's a huge effort from different specialized data providers to bring everything in the right place and enable providers like us to utilize those data in the highest quality way.
I think there is a vast under-appreciation, I don't know if it's the right term, with like the depth, the quality of data you need to have in-house, no matter which role you play in this ecosystem. And I think at Dune, we're a little bit this neutral player, so to speak, with a lot of chain data. But there is a very heavy correlation between the data team sophistication with the institution or player we work with, and I think maybe their performance or how they're like embracing DeFi. And I think people are really massively underlooking at what it takes to actually run a business, and the fact that people are sometimes making calculations that are different depending who you ask. Those are KPIs. There shouldn't be like different way of calculating this, but it's kind of the case in some instances, which is a little bit scary when you get into big numbers, right? So maybe a recommendation for people in the room is like really invest more in your people, process, and technology when it comes to on-chain data, because that's the key of, everything is data to some extent, so in crypto. So that's probably something that I would invest a lot more if I would be in the room right now.
I would add a few things, but just so you all know, we've totally derailed Charlie's
He doesn't know where we are in the script.
So sorry to Charlie, and I hope you're enjoying it. It's totally freeform.
No, but actually one point that comes up in this discussion is you guys are talking about the challenges of getting all this data from on-chain and synchronizing it, harmonizing it, as you said. And but I think that there's a lot of opportunities as well that it's not just challenges, right? There's actually new functionality that can be built in terms of having these things being traded, being able to see changes and adjust ratings as soon as these changes actually happen on chain, because this is the source of truth, so you can actually view that right away. And maybe Arnaud, you'd be best to answer this question, which is, a lot of these institutions, they see how if you're a big player in the crypto space and you're making a trade on chain, everyone can see that, right? And Dune can track that. You have many wizards on Dune who are tracking many of these players as well. But if you're a large institution, that might not, it's definitely not something that you will want to happen. How do you think of Dune, about this trade-off between privacy, confidentiality, but still having that transparency?
Yeah, I think we all know like the benefit of blockchain, transparency, speed, and many other things. And I think I will understand why it might be a little bit scary for some people. I think we are the kind of an influx point. If you think about, I don't know, like a market fund, like where people you have the flow data on chain, but again, you're missing some of the composition of a portfolio of things that you would want to have, in my opinion. But there are ways to provide that confidentiality, right? I think it's Aave Arc, they're doing very well, right? The protocol is on chain, but how do you access it, or who's accessing it? It's KYCs, but it's hidden behind, very sophisticated, ZK proof protocol. So I understand it might be scary for big organization to show what we're doing on chain, but I think people are embracing it. We did some work back a few years now with Katie Wood when they launched their Bitcoin ETF with 21 shares. And she was talking also about the change in the investor relationship, right? So we have this say at Dune that says the revolution will not be reported quarterly, because it's still like the mind of like not having this 24/7 access. And I think they're like, actually, it's great. Like, you want to see what's happening on chain? Here's your link to your dashboard or what's happening. And as long as you can still remain some of that data private, and you can, right, literally, through, cryptographic, obviously, access or whitelisting, I think it's great. But it's just, I think it's frustrating to see that we're putting a lot of things on chain, but we don't do the full circle. There's always a gap, whether we talked, earlier in terms of some of the defaults. For market fund, it's more like who is accessing it type of thing, or what's happening. But we're getting better. To stay positive, I think it's a massive, journey that we're on. And
yeah, but there are interesting points, Arnaud, just to jump in. So on the one hand side, I guess it's a good sign for institutional participation that we're trying to figure out how to create more privacy on blockchain ecosystems. The other way around, it also creates additional work, because issuers are trying to integrate this privacy, and we both try to decrease the privacy because some parts of the work that we're doing together is mainly about labeling transaction on chain. So to really understand, is it a mint, a burn, a transfer, so on and so forth. And every time somebody's trying to hide it, of course, our job to assess the risk is getting harder. So there are good and bad parts. Institutional participation is very well received, but on the other hand side, sometimes I have the feeling we are recreating legacy systems when we are now trying to build formally open, permissionless systems in a very institutionalized way with all the privacy features that people want and maybe also need. But on the other hand side, it also derails a little bit why we all started and what was really the disruption which could be possible.
Yeah, I mean, you guys need to, working with your partners and your customers, users of your data and your services, to strike the right balance between the need for privacy and transparency. I mean, someone said on one of the panels this morning, you can't escape KYC and AML if you're a financial institution. You have to go through that. So it cannot be, I mean, at least as of today, it cannot be like fully private in that sense. So that's really part of what you need to figure out with your stakeholders.
So do you guys think everything should be on chain at the end of the day?
Depends on the perspective.
I have no skin in the game. So and the truth is, like, that's why you can trust me. So because it doesn't really matter to me. I'm also in charge of AI. I'm going to tell you I'm very busy with that. So it doesn't really matter. I do feel that most of the stock of existing products today, so I'm not even talking about the new stuff that's coming up, will be at some point on digital platforms one way or the other. And I think it's important for everybody here to get ready for that and to make sure that when everything is digitalized, you're ready to ask the right questions, you're ready to get the right data with the right frequency, you make sure that you can manage your risk differently in a more modern way. So should it be or not? That's a question for others. Will it be digitalized or not? Probably the entire stock will be digital in the near future.
Yeah, I think that all the data will eventually be on chain, but not everyone will have there will be differential privacy where the people who need to view that data, they'll have cryptographic guarantees that they can access that when they need to, and then you'll have similar crypto guarantees for privacy for everyone else who doesn't necessarily need to be privy to those sorts of transactions. And so I think that technology, is still very nascent, but definitely will be upcoming. I think that's all the time that we have for this panel. Thank you everyone for your attention. Thank you all panelists.